In the final weeks of 2025, President Trump made a bold declaration about 2026. He said the economy is poised for an economic boom, the likes of which the world has never seen. And immediately after that statement, something remarkable happened in the financial world. For the first time in decades, every single Wall Street analyst is predicting the stock market will rally in 2026. Not one of the 21 major forecasters is calling for a decline. The S&P 500 is already up 17% this year, and Wall Street's median target puts it at 8,011 by the end of 2026. That's another 15% upside from current levels. But here's where things get interesting. While Trump is promising this economic boom, Fed Chair Jerome Powell is now under criminal investigation by the Department of Justice. Some analysts are calling this an unprecedented attack on Fed independence that could actually accelerate the very policies Trump wants. Well, here we are in January 2026, and I'm going to break down the three massive economic shifts happening right now that are designed to make investors rich while leaving everyone else behind. And then I'll show you exactly how to position yourself to profit from what's coming, because the people who understand this are going to build serious wealth in 2026. So stick with me until the end of this video, because what I'm about to reveal could change how you think about investing forever. The reason why this is so important to understand right now in 2026 is because investment opportunities are changing faster than ever before. We have massive changes happening with AI infrastructure. We have government policy changes that are redirecting trillions of dollars. We have Federal Reserve leadership changes happening for the first time in 8 years.
Action.
And all these changes are creating new investment opportunities that you don't want to be left behind on. There are three specific pillars driving this 2026 boom that Trump and his administration have put in motion. Number one is the Fed power shift that's happening in May. Number two is massive government stimulus, but I'm not talking about stimulus checks.
Look at the volume spike coinciding with the decline in the tech sector.
Number three is a system that's now designed to backstop investors at any cost. Now, the artificial intelligence boom could turn to bust, the economy could defy expectations, and Trump's policies could bring unanticipated shocks.
We need to offload those shares immediately before the index drops further. Buy the pharmaceuticals now, they are stabilizing.
Massive year. And this is why you want to be ahead of these changes, not behind them. Because the people who understand where the money is flowing are going to be the ones who profit.
Here is your card and receipt,
madam.
Madam.
Slowly watch
Thank
the
you for shopping with
power
us.
get exploded away.
The shoes.
So let me break down these three pillars one by
the
one,
Fed funds
starting
rate
with the
hitting a new
Fed power
20-year
shift that's
high,
about to change
significantly
everything about
increasing
interest
borrowing
rates in
costs for
America.
consumers.
Starting with the Fed power shift. Now, most people don't realize this, but Fed Chair Jerome Powell's term expires on May 15th, 2026. And for the first time in 8 years, we're going to have a new head of the Federal Reserve. Here's what makes this so significant. Powell is currently under criminal investigation by the Department of Justice.
I think this layout really highlights the key metrics we discussed.
Now, Powell himself said this investigation is really about the Fed setting interest rates based on economic conditions rather than following the president's preferences. But here's the thing. Some analysts now expect the Fed to stay on hold throughout 2026 because of this pressure, and that actually creates a perfect setup for Trump as replacement to come in and be the hero who cuts rates aggressively. Trump has been very clear about what he wants. He's been pushing for a 1% federal funds rate, which would bring us close to pandemic-era levels, some of the lowest interest rates in history.
We were able to get those rates lowered for you,
I bet he's going
down
to choose someone who
3.5.
aligns with his vision for lower rates. Now, most analysts expect 1 to 2 rate cuts in 2026, bringing the federal funds rate down to the 3% to 3.25% range. But here's what most people miss about how this affects you as an investor. When the Fed cuts interest rates, it's not just about making mortgages and car loans cheaper. The Fed has also resumed buying treasury bills at a pace of up to $40 billion per month. They call it reserve management, but what it really does is inject more money into the financial system. Lower interest rates mean big institutions, hedge funds, and Wall Street banks can borrow money cheaper. And what do they do with that cheap money? They dump it into the stock market. More buyers means higher stock prices. It's basic supply and demand. But there's another layer to this. With rotating Fed officials, we're getting new hawks who prefer holding rates steady, which means when Trump's pick does start cutting rates, it's going to feel like a massive policy shift. The contrast is going to drive even more money into stocks. This Fed power shift isn't just about interest rates. It's about ensuring the entire monetary system supports asset prices and investor wealth. Which brings us to pillar number 2, the massive government stimulus that's already flowing. Now, let's talk about pillar number 2, massive government investment. And this is where things get really interesting because we're not talking about stimulus checks or unemployment benefits. We're talking about the government putting your tax dollars directly into the stock market. In July 2025, Trump signed the One Big Beautiful Bill Act into law, the $3.4 trillion spending package that most people have no idea about. This isn't just extending tax cuts. This is the government actively investing taxpayer money into publicly traded companies. Here's what's happening with AI infrastructure specifically. Trump recently announced over $90 billion in new private capital pledges for AI and energy infrastructure, including $25 billion from Google and another $25 billion from Blackstone.
A landmark deal for both our firms.
The government is now directing $15 billion emergency auction to force tech companies to pay for new power plants. Now, they're framing this as making big tech pay their own way. But here's what they're not telling you. The government is also the one funding the infrastructure that supports these projects. Think about it this way. When the government spends money building data centers, upgrading the electrical grid, and supporting AI infrastructure, where do you think that money goes? It goes to publicly traded companies, construction companies, technology companies, energy companies, all trading on the stock market. Trump has declared AI data centers a national priority, which means faster permitting, regulatory rollbacks, access to federal land, and potentially hundreds of billions in new investment. When the government removes regulatory barriers and fast-tracks these projects, it directly boosts the stock prices of the companies involved. But here's the part that most people miss. The Federal Reserve is now buying $40 billion worth of Treasury bonds every month to fund this spending. So when the government can't borrow enough money from regular investors, the Fed just prints it and lends it to the government. This creates a perfect circle. The government spends money on infrastructure projects. That money goes to public companies. Those companies' stock prices go up. The investors get rich. And when the government needs more money to keep spending, the Fed just prints more. McKinsey estimates that the global price tag to scale AI data centers could hit $6.7 trillion by 2030, with $5.2 trillion earmarked for AI workloads. That's not just private investment. A huge chunk of that is going to be government-backed. And here's the thing. This isn't temporary stimulus. The One Big Beautiful Bill Act makes most of these policies permanent, with some provisions running through 2034. This is a structural change to how our economy works. The government has essentially said, we're going to spend whatever it takes to win the AI race. We're going to support these companies with taxpayer money.
Well done,
we're going to make sure investors profit from it. Which brings us to pillar number 3, how this entire system is now designed to make investors rich while everyone else pays the bill. Now let's talk about pillar number 3. How our entire economic system is now designed to make investors rich while everyone else gets left behind. And this is something most people don't understand, but once you see it, you can't unsee it. Here's how it works. There are 3 players in our economic system. I call it the CIB system: the consumer, the investor, and the business. You as a consumer go to businesses and spend money, whether that's Chipotle for lunch, Apple for a new phone, or Amazon for shopping. But here's the key. When you spend that money, who actually benefits? It's not the workers at these companies. They might get small raises here and there, but all the extra dollars you spend go into the profits, and those profits are owned by the investors. So every dollar you spend as a consumer ultimately ends up in the pockets of investors. Now, the Federal Reserve has resumed buying Treasury bonds at $40 billion per month US Bank. This is money printing, plain and simple. When more money gets created, it causes inflation. And when inflation happens, everything you buy as a consumer becomes more expensive. Your groceries cost more. Your gas costs more. Your rent goes up. But here's what happens to that extra money you're forced to spend because of higher prices. It goes straight to the businesses as higher profits. And who owns those profits? The investors. So inflation is actually a wealth transfer mechanism from consumers to investors. The more money gets printed, the more expensive things become for you, and the richer investors get from those higher profits. The cost of electricity is up 6.7% nationwide over the last year, and nearly 30% since the end of 2021 CNN. When your electric bill goes up, where does that extra money go? To the utility companies. And who owns the utility company stocks? Investors. But here's where it gets even more interesting. The One Big Beautiful Bill Act will cost $3.4 trillion over the next 10 years, bipartisan policy center. That's deficit spending, the government spending money they don't have. And who's the largest spender in our economy? The US government. When the government spends money they don't have, that money goes to businesses through contracts, projects, and programs. And again, who benefits from those business profits? The investors. So now let me show you exactly how to capitalize on what's happening. And I need to give you the disclaimer first. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. That said, here's how smart investors are positioning for 2026. The simplest approach is to invest in the broad market. Wall Street's median target puts the S&P 500 at 8,011 by the end of 2026, implying 15.5% upside from current levels. Ed Yardeni expects the S&P 500 to rise to 7,700 at year-end 2026, suggesting a gain of almost 12.5%. You can get exposure through ETFs like SPY, which tracks the S&P 500, or total stock market funds that give you broad diversification. This way, you're betting on the entire system that's designed to support investors. But if you want to be more strategic, you follow the money. And right now, the money is flowing into specific sectors. First is AI infrastructure. The government has announced over $90 billion in AI and energy infrastructure commitments, including $25 billion from Google. When the government is actively supporting an industry with this kind of money, you want to pay attention. The $15 billion emergency auction for data center power infrastructure is going to benefit utility companies, power generation companies, and data center operators. These are publicly traded companies that will directly benefit from government policy. Second is the companies building this infrastructure. Meta is raising $29 billion from private credit firms to build out data centers, and they've signed a 20-year nuclear energy agreement. When you see this kind of massive private investment being backed by government policy, those are the stocks you want to research. Third is energy companies. The Energy Information Administration projects that U.S. power consumption will reach record highs in 2025 and 2026, driven in part by data centers supporting AI. Energy demand is exploding, and the companies that can meet that demand are going to profit. But here's the more sophisticated strategy. You follow where the government is literally putting taxpayer money. When the government invests directly in companies through programs, contracts, and initiatives, those companies tend to outperform. Now, I'm not giving you specific stock recommendations because that's not what I do, but I'm telling you to research the companies that are benefiting from these massive government programs. Look at who's getting the AI infrastructure contracts. Look at who's building the data centers. Look at who's providing the power. Wall Street analysts expect S&P 500 earnings growth to accelerate next year, driven by strength in the technology sector as the artificial intelligence boom continues. So technology stocks are likely to continue leading the market. But remember, this is not about trading. This is about positioning yourself for a long-term wealth transfer that's happening in our economy. The artificial intelligence boom could turn to bust. The economy could defy expectations, but the system is designed to support investors through whatever happens. You can also diversify across different asset classes. Real estate investment trusts that own data centers, infrastructure funds that benefit from government spending, energy funds that profit from increased power demand. The key is understanding that this isn't just a normal market cycle. This is a structural change in how our economy works. The government is actively supporting certain industries with trillions of dollars. The Fed is printing money to fund this spending. And all of that money ultimately flows to investors. Your job is to position yourself on the right side of this wealth transfer, because whether you participate or not, it's happening. The question is, are you going to benefit from it, or are you going to be the one paying for it? Again, this doesn't guarantee any specific returns, and you need to do your own research. But understanding how the system works gives you a massive advantage over people who don't. So let me recap what we've covered today. We talked about the three pillars driving the 2026 economic boom that Trump has set in motion. First, the Fed power shift happening in May when Powell's term expires and Trump picks a replacement who will likely cut rates more aggressively. Second, the massive government investment flowing into AI infrastructure, data centers, and energy projects through programs like the One Big Beautiful Bill Act. And third, how our entire economic system is now designed to transfer wealth from consumers to investors. Every single Wall Street analyst is predicting the stock market will rally in 2026 for a fourth straight year Yahoo Finance. And now you understand why. It's not just market optimism. It's because the government and the Fed are actively supporting asset prices with trillions of dollars. The people who understand this are going to be the ones who build serious wealth in 2026. The people who don't are going to be the ones paying for everyone else, as wealth through higher prices and inflation. Now, this doesn't mean markets can't go down. This doesn't mean we won't see corrections or volatility, but it does mean that the entire system is backstopping investors in ways we've never seen before. Either you can understand this system and use it to your advantage, or you can ignore it and watch your purchasing power slowly get eroded away. But at the end of the day, this is what's happening whether you like it or not. If you got value out of this video, the best thank you is a referral. So if you could please share this video with a friend, family member, colleague, or fellow investor, that helps us continue spreading this type of financial education to people who need to hear it. And if you want to stay updated on these kinds of economic shifts and investment opportunities, make sure you subscribe and hit that notification bell. Because these changes are happening fast, and the people who stay informed are going to be the ones who profit. Thank you for watching, and I'll see you in the next video.